Mike, I often think of getting a multifamily, and I think, hey, wouldn't it be nice to collect the checks at the end of the month and have some additional cash flow? You're telling me cash flow is not where the value is.
Cash flow's king. No. Look, there's a couple different ways to look at it. Cash flow is important. Obviously, this is coming out of a LinkedIn post that I made where I said I dramatically said I don't buy real estate for cash flow. It's actually true. That's not why I buy real estate. But cash flow is important, and there's kind of two ways to look at this. You can look at, and similar, frankly, with any investing, you could look at stocks, and you could buy stocks that spin off a dividend for you every month, right? And you can buy Chevron, and you know you're going to get a 4% check every year based on the dividend, and it's going to grow slowly and steadily. Or you could invest in Tesla, and it's not going to pay you any dividend, but it might go up 300% in a single year, right? So it's kind of two different philosophies. Am I looking for growth or am I looking for income? There is a balance in the middle. We tend to look at real estate investing. We're primarily merchant builders. So we build, we stabilize it, we sell it, we take the profit, we do it again, and we do it again, and we do it again. So we're kind of on the growth side of things, right? We're focused on what the appreciation is going to be. How can we build equity? Even for the things that we hold, the cash flow is not as important to us as, the other pieces. Is it in the right community? What's the long-term growth story? What's my long-term ability to, get out of this deal and have a significant profit on the other end? And what are the other intangibles of real estate that really, really matter? So primarily for us, those are the ability to put debt on it and take that debt out of the deal through distributions, which is tax-free. It's basically tax-free income. And then the ability to use depreciation in the tax code to pay little to no taxes. That's the key in owning real estate.
Can we talk about that when you're saying so you take that debt and then...
So let's take a really simple scenario. You buy let's boil it down, like not even use my big deals. Let's boil it down to a 3-family. You buy a 3-family and you renovate it even lightly. Say you go in and put new kitchens in. That's it, right? Like say you put 20 grand into it, not a big deal. And then you put new tenants in it, and the new tenants are paying $250 a month more on each of the units than the previous tenants were because you put new kitchens in, right? So that we call that in the business value add. You've added value. You then go refinance the debt. The building's going to be worth more because your rent roll is worth more. You have tenants paying more in rent. Say you're able to cash out $100,000, right? Your original investment, and then you've now, with the new debt, you've able to cash out $100,000 in cash, right? That's not taxable. That's debt. Goes right in your pocket. Yeah, your property's paying the bills on it.
And you're paying interest on it.
And you're paying interest on it, but your property's covering it. But that's tax-free, right? That's not $100,000 in income. That's $100,000 in debt proceeds.
Yep.
Right? Now, if you were to blow that out to a big project, we finish a big project and go refinance and put the perm debt on it. Sometimes $1, $2, $3, $5, $8 million comes off the table. That's material, right? You're not paying 45% federal income taxes on that. That's debt proceeds, right? So there's a lot that you can do there with that. In terms of the intangibles, depreciation's the big elephant in the room, right? So the way the federal government looks at this is real estate's a depreciating asset. So in real life, we know that it's an appreciating asset. The exact opposite is true, right? Like even as the building is physically falling apart, it's becoming worth more and more, right? Take a look at any house built in, there's a lot of houses around, we're in the North Shore, there's a lot of houses built around here in the 1700s, 1800s, right? Loads of them in the 1800s. Those houses are 200 years old. Theoretically, the way the government looks at it, they should be worth zero. And yet there's houses here that were built in the 1800s that are worth $3 million when in the 1800s it was $2,000, right? They've appreciated magnificently. So with depreciation, you're able to take the value of that asset and write a portion of it off every month as a loss. So even though you have a property that's profitable, it's paying you money, you're making money every month. On your tax return, that property's a loss, right? So you're not paying, by and large, for most investors, you're not paying any taxes on that income. It's basically tax-free. It's a shelter. You can use that if you're an active investor like we are. You can use that to shelter W-2 income. You can use it to shelter other capital gains. You can use it to shelter investment income. And really, This is the humorous piece of, right, when people look at politicians, or like, everybody looked at Donald Trump and like he paid no income taxes. No, he didn't pay any income taxes because he's a real estate guy. And frankly, his depreciation schedules were such and his passive losses were such that he at 1 year had a $900 and something million passive loss. Imagine how many years of income you could shelter with $900 million of losses that you're just carrying forward. That's 10 years. Theoretically, in that example, you take that one passive loss of $900 million, you could make $100 million a year for the next 9 years and pay no income taxes because you're using those losses, right? So that's, at the end of the day, that's how the tax code works. It makes real estate a really, really, really powerful investment tool. The Tax Cuts and Jobs Act in 2017 brought in significantly accelerated depreciation, where you could write off 100% of certain categories of that building in year one. So it was taking, instead of spreading that depreciation over 27 years, it was taking 20, 30, 40% of that nut and giving it to you in year one. So in year one, you were getting a $7 million loss that you can then continue carrying forward in addition to the normal depreciation losses. So it's very, very powerful. And it's a core reason why a lot of people will buy real estate. They want the depreciation losses.
And isn't there something if you're selling and doing a 1031 exchange or whatever and rolling it into the next project, but when you do go to eventually recoup those dollars, aren't you going to eventually pay taxes?
So two different things. So on a 1031, the goal of a 1031 is to do it until you die. And when you die, and again, it's not like you can't get at the money because you're refinancing. You're getting at the money through debt. So the way 1031 exchanges work is you exchange one property into another. You don't touch the cash, and you're theoretically rolling all the profits forward, and you're upsizing the property as you go. Theoretically, then you do that all the way until you die. And on your death, your heirs get a stepped up basis. So if theoretically you had taken a portfolio that was worth $100,000, and by the time you die, it's worth $1 million, instead of your heirs paying taxes on that $900,000 in gain, their basis gets stepped up to the $1 million. They pay zero. So 1031s are very, very efficient if you don't break the cycle during your lifetime. If you break the cycle during your lifetime, you pay taxes on the whole thing.
Yeah. See, I've just recently had a conversation with someone who broke the cycle because they wanted
access to the cash.
They wanted access to the cash, and then they had to.
So this is why opportunity zones are better. We'll get to that.
Yes, and they had to pay a tremendous amount of taxes because that basically.
Well, it negated. You could negate 20 years of exchanges, right? You're going to pay on the whole thing. The depreciation losses do get clawed back on a sale, but at a different rate. So if I take a depreciation loss today, I'm taking passive losses on property today, I'm avoiding a roughly 50% tax bill. Me, right? I'm a large investor. It would be the top marginal rate for me. So I'm avoiding, call it a 50% tax bill. When the depreciation is clawed back, if I sell that property, the government kind of is like, hey, give us those tax credits back. It's taxed at 25%. So it's still worth doing, right? I'm still cutting my tax bill in half.
Okay. And then the equity piece.
So
you're increasing because and for people that are listening, and we didn't read the whole post, but you said the three things were debt, tax avoidance, which is what we were just talking about through depreciation, and then to build equity.
Yeah. So to me, building equity is the growth in the asset. You can then use that equity to secure other things. You can use that equity to cash out. That equity is your profit when you go to sell the building. What happens with a lot of people that stretch to do deals, that are just focused on the cash flow side, is just getting it cash flowing, is they can never build significant equity in it. Or at times they can't build significant equity in it. So for us, if I list my top three, right, it's the ability to put good debt on it and take advantage of the rules around that. It's the ability to avoid taxes, not just on that asset, but across the portfolio and across my personal kind of income spread. And then it's to build equity. Equity gives you lots of options in our perspective, right? You're able to then double down again and again and again using that equity. I can tell you that we would not be where we are positionally as an investor, as a company, if we hadn't been able to leverage the equity we had in deals. You know, the first deal built the second deal, and the second deal built the third and fourth deal, and the third and fourth deal built the fifth, sixth, seventh, eighth, ninth deal, right? And then those deals are going to build, right? And you're able to leverage that equity as you go. If all we were focused on was the cash flow there, you're focused on what it's spinning off every month or every quarter, and not focused on what the whole asset's worth where you can redeploy that capital.
Got it. Yeah, and that's like the key, because there's a different mindset. If you owned a piece of equipment, you're really thinking about what is
equipment utilization. What's your utilization rate, right? How many days is that excavator cash flowing for us, right? I mean, when we look at our business that way.
Yeah, but that excavator is never going to appreciate and give you equity. Right.